Good morning and good afternoon, depending on where you are in the world. Of course, welcome to our 8 panelists, but also to all of you out there who are watching the live stream, and all of those in future who will watch the download. So this is our annual visit to the world of Latin American sovereign bonds. We should do it more often, definitely, and I undertake that we shall. But several of our speakers here are old friends. We've got 4 sovereign issuers, 3 portfolio managers, and just to keep us all on the level, our favorite Washington attorney, Gregory Harrington from Arnold & Porter. So let me introduce first the sovereigns. We've got joining us from La República Oriental del Uruguay, henceforth Uruguay, Joaquin Alvarez, who's the senior advisor in the Ministry of Economy and Finance. Paula Espinosa is General Director of Financial Operations in the Ministry of Finance at Mexico. And Paula, you might remember, was, I'm sure she does, with us at about 1 hour's notice last year when her boss put her in to substitute. We have Victor Gonzalez, Head of Public Debt in the Ministry of Finance of Chile, and Daniel Leal, Undersecretary of Public Debt in the National Treasury of Brazil. And our portfolio managers are Jared Liu from William Blair, Khan Nazli from Neuberger Berman, and Gary Sedgwick from RBC Blue Bay. I must get used to putting the RBC in after so long of it just being Blue Bay. So we're here to unpack over the course of 120 minutes every aspect we can think of the Latin American sovereign bond markets and factors that affect those markets, obviously geopolitical ones as much as anything else, plus general economic ones. And just to get the conversation started, there's a bit of sort of the emerging markets phenomenon that we all grew up with in the, I suppose it's starting in the early 90s, has run and run. It's felt as though there's been somewhat less diminished interest in EM as an asset class in more recent years. But it seems that institutional investors have regained their enthusiasm, and we're set for a pretty busy year this year. I mean, certainly just if you look in the DCM side of things, January has been positively explosive in EM issuance. So I'd just like to go back to that kind of fundamental case for EM investment that we all grew up with, you know, economic reforms, young populations, rising middle class of educated consumers, and so on. Well, Victor, I'm going to turn to you because you're the kind of, Chile is the kind of original emerging market. I hope that doesn't sound good or bad. It's meant to be good. Where do you put Chile, obviously in particular, but the wider region into an EM context now, looking at it, you know, 35 years after reforms began?
Well, thank you. Thank you for the invitation, Chris. Regarding your question, I think that what's the story of the last year is that the COVID is finally over. So we are in a clear path of recovery. In Chile, for example, and in other countries in Latin, we have certain issues with the pension manager and so on. So finally, the demand, the internal demand in means is finally recovered. The transition to a normal inflation, it's already there. But along with that, the process, all the volatility in the external market and what's happening in the US, especially during the mid part of the year, I think that partially influence a higher participation of foreign investors. So LATAM is more attractive in comparison. But still, it's difficult to differentiate the effects from the carry because during the mid part of the year specifically, there was something of that. With the issue that the investor community is looking for safety or diversification in the local markets, and specifically in the region. So Chile certainly experimented certain huge increase in the foreign participation, but still, if we compare in a historical trend, for example, with the previous COVID situation, the participation is relatively the same as before. So the big question right now is with the carryover, if the trend will continue or not. So that's the question. partially will depend on the situation in US, the geopolitical risks, and so on.
Well, we're certainly going to come on to that, and we're absolutely going to come back to you to talk about what you've been doing recently and what you're planning to do. Because I think, just as a preview, haven't you now got something like 40% of your debt stock in sustainable or social form?
Yeah.
Which I don't know if that's the highest proportion in the world, but I wouldn't mind betting that it is. So, Jared, please come in, comment on the general point I was making, but also perhaps tell us if you think that investor interest will continue to grow in EM as an asset class, especially, of course, in Latin America.
Yeah, thanks, Chris. I think the general reasons to invest in emerging markets haven't really changed a whole lot over the last 20, 30 years. But what has changed a bit is, the rest of the world and the landscape. And, one of my colleagues who's an EM equity manager gave a presentation to the firm a couple of weeks ago. And one of the points he was making on why it's particularly attractive at this point in time is these long dollar cycles. And, one thing that I talk about quite a bit with, clients and internally is the relative performance of emerging market hard currency debt versus local currency debt. And in previous decade, where it was in, the 2000s, the 2010s, and the outlook for today, if you look back to the 2000s, EM local was the hot thing. It massively outperformed hard currency. And then something shifted in the previous decade with this very strong dollar regime that we had. And I think it's particularly interesting at this point, because if you look to Victor's point, some of the changes in stated U.S. policy regarding, even though they're not very explicit, but given the publication of the Mar-a-Lago Accords, there are some questions about the advantages from the U.S. administration's point of view of a strong dollar, and what that can mean for investing in emerging markets. And one thing I find particularly interesting as I talk to many asset owners in the U.S. is their own concentration risks within their own domestic economy. So I think as more uncertainty on the dollar and more uncertainty on the geopolitical environment, you could see a long bull run for emerging market assets. But as my old boss used to say, theories are easy, facts are hard. So we'll see what actually happens. But I think it's becoming a lot more interesting at this point in the cycle. So
good. Well, I mean, I'll quote an old friend of mine, Jerome Booth, who literally wrote the book on emerging markets. He said the difference between EM and DM is that in EM you get paid to take the risk.
Yeah, that's actually one interesting chart. If you take a look, if you decompose like IG and US credit, US and high yield credit, and you do 50-50 split of that versus just the emerging market index, which is, more or less split rated, EM, to your point, just shoots the lights out versus US comparables. But sorry, I kind of interrupted you.
No, that's quite all right. I'm glad. This conversation is about interruptions, everybody. So, Khan, just a word from you on this sort of introductory topic. What do you think now in the with many decades, none of you quite as many as me, I suppose, but many decades to look back upon of hearing and talking the EM story. What are the fundamental reasons to buy EM?
So we started last year, 2025, thinking that 2024 has been such a strong recovery year from EM starting at the end of 2023, and it just can't go forever. Trump has come in, there's lots of risks, and things will have to somehow be much more modest. And we've seen, as you mentioned, quite strong performance, both local and hard currency side. So, and I think behind this was, of course, a lot of geopolitical and external reasons and developments, but there was, I think, an undeniable improvement of fundamentals that we've seen. When we look at EM, we see a consistent 2 percentage point plus the outperformance in growth dynamics. We do see in a lot of places, especially the company that we are with here, external debt is no longer an issue. Dollar debt is no longer an issue. It's only a diversification for the issuers. And then when we look at the number of upgrades, rating upgrades versus downgrades, the net upgrades are at historically high levels if you look at the past decade or so. So this might actually be, 2004, 2005. Add to that, strong commodity cycle that we're seeing. Of course, there has been a lot of volatility around gold, but there's undeniable, commodity push too. So we could actually be in 2004, 2005, but you had every reason to be a bit skeptical of valuations and how the market has moved. But there was still another, decent 2-3 years to go before you had that obvious in the U.S. Driven, external shock to the system. So so generally, I agree with the comments before that we are, we are pretty constructive on EM currently.
Well, we'll come back to the reasons why people.
I'm so sorry.
I'm sorry, Paula. I was about to turn to you anyway, but
yes, don't worry.
We come back to the reasons for potential reasons for worry. But Paula, please comment on what you've heard so far, and then I have a specific question to you to move the conversation.
Sure. I think that from a market's perspective, the geopolitical uncertainty has reinforced the importance of being the predictability and continuity in policy frameworks. Investors are increasingly differentiating among emerging markets based on how well they can navigate external shocks rather than geopolitical narratives alone. That's something that changed a lot since COVID. And I think for story-even issuers, the environment underscores the value of having a diversified funding strategy and a broad investor base. In case of Mexico, has helped us absorb periods of global volatility. While geopolitical risks remained a now constant feature of today's landscapes, markets continue to reward countries that are able to adapt to structural changes in the global economy and also to maintain consistent engagement with investors. I think that's one of the main pillars in our case.
Yeah, and the specific topic of investor relations we'll come back to later in our conversation. I'll stay with you, Paula, but just if I may, Kaan, your microphone was starting to sound a little choppy there, so I don't know if you can maybe fix that before you speak again. I don't know. But so it seems appropriate, Paula, to ask you, Mexico is, of course, famously tan lejos de Dios, tan cerca de los Estados Unidos. She's not smiling, so she doesn't like that. Mexico, poor Mexico is so far from God, so close to the United States, as people have said that for years and years. So I'm going to ask, I know you're a government official, so you can't say very much about it, but it is in the minds of every bond buyer, every investor of every kind, what might come next from the US administration. Kaan, you mentioned the word Trump twice. Next to these panels I do, I'm going to have a bell, and I'm going to hit it every time the word Trump gets mentioned. But sometimes it feels as though it's going to be banging away throughout. But the Don Roe Doctrine, as we were introduced to it earlier this year, probably, insofar as it's a reality at all, plays somewhat differently for Mexico than for other countries in the region. But do you feel that political or geopolitical risk stemming from the actions of the US administration, but also from this very strong and growing tension between the US and China, is a factor when it comes to people buying UMS bonds?
Well, I think financial markets, as you say, I'm a sovereign, so I cannot. My political answer cannot be as you expected. What I can say is that I think financial markets, especially the local market in Mexico, appear to absorb new sources of global uncertainty. And that includes the productive chains, the change in the productive chains that has opportunities for other countries. Some countries that might say it's like something bad, but it's also opportunities for other countries. situation of nearshoring in Mexico have improved considerably, and that help us with investment and with the financial position that we have. I think the problem with tariffs, it's also has impact all around the world, and we can see that in different indicators. But I do believe the relationship that we have with the United States, we're really nearby. We have the treaty with Canada also. So I do believe that we have a lot of potential growth in that place. In the case of China particularly, as I tell you, I think that was an opportunity we had for years to evolve our production chains.
Yes.
Of how we have it. So I think it was something, an improvement, but also, I'm telling you, the thing with tariffs and everything, it has an impact globally, and it's impacting us also, but I think we are in a good position due to other treaties that we have.
So it's just the weather, basically, and everybody has to deal with it. I mean, you're right to point out a difference, because it's fair to say that while for much of Latin America, China is a customer, Mexico is a competitor in terms of manufacturing goods for the US. So Daniel, you haven't spoken yet. You've been very patient. It's fair to say that Brazil, being the biggest economy, biggest country in Latin America, has a bit more of a sort of stick to wave back at Uncle Sam. Again, I preface this question by acknowledging your role as a government official. But how much are these geopolitical pressures feeding into your everyday life?
Thank you, Chris. Good morning or good afternoon to everyone. I think I will repeat what I have been saying throughout last year, when all those turmoil started with Liberation Day started. Brazil has tried to point that he doesn't want to take any one side. So he is someone who values the relationship not only to the US, but to China as well, since China is the one biggest partners or commercial partner of Brazil. Saying that, throughout last year, there was a lot of noise, geopolitical noise, especially in the middle of the year, July, August. There was that fade away after both presidents, Lula and Trump, they had a talk, I think was by the end of September, that removed the relationship, and Brazil showed the importance that the US has on our economy as well. So we don't have them as enemies, is more as partners. So saying that, even though there was a lot of noise, but on the day-to-day basis, that didn't impact a lot on the Brazil economy. At the beginning of the year, when tariffs hit the world, Brazil had a diversified economy. We had different partners that we were able to diversify our exportations. So I think the impact on GDP was contained. And even though on July, when we had like the sanctions and all those the discussions heated up, we still were able to try to open a dialogue and try to show that we are not here to be anyone's enemy. And with that, we didn't see any trouble financing our debt. I think levels and spreads can show that how investors are seeing Brazil as a strong economy that has been growing, who's trying to address the fiscal situation. And even though with those tariffs and geopolitical discussions, that I think the strong momentum that Brazil has surpassed that.
Yeah, I mean, obviously nobody doubts Brazil's credibility, massive reserves, massive economy. One comment I'll just make, which takes me back to 23 years ago, would it have been, when Lula was first getting elected. Everybody was very worried, and a Brazilian friend pointed out to me, don't worry, we think of him as a sort of left-wing ideologue, but remember, he was actually, for most of his career, a trade union negotiator. And trade unions are people, representatives of trade unions are guys that negotiate a better deal for their members, pay, conditions, holiday, health, whatever it is. So much like everybody says Trump is a transactional president, maybe Lula's a transactional president too. So anyway, I won't ask you to comment on your president because you're going to have a new one before long anyway. But I will go over to Gary hasn't spoken yet. So Gary, I'll come to you, and you can just give us your view on the Don Rowe doctrine. Not in every detail of it, but the bigger picture.
Yeah, thanks, Chris. Yeah, so for us, the way we were looking at it, I'm sure a lot of investors in our seat are doing, is almost this friend or foe type of policy that's been announced from the US, and whether you're on side with the US or you're obviously more of an adversary and pushing back against this new policy that's coming out of the US. And we've seen the rewards have come through for certain countries that have obviously sided and supported the initial Trump policies and been supporters of the agenda, such as Argentina, whereas others that have pushed back against initial policies, such as Colombia, have obviously faced the kind of fire from the White House in terms of sanctions on the president, etc. So it's careful to manage that, but we do see it can be managed. That even Argentina, and I met with a LATAM sovereign that was in London this morning, and the way people are thinking about it, and a lot of countries' exports, the biggest export market is to China for goods, but on services it's to the US. So obviously both economies are extremely important to both, and it's about how you manage those relationships. And obviously the US is what we've seen. They are happy for that trading relationship with China to continue, but really where they are starting to kind of stamp down and have issues is more on the critical infrastructure side, whether it's the ports in Panama or even in Peru.
Yeah.
And so those are the ones that need to be more carefully managed going forward. So for us, is keeping track of those relationships, seeing where the risk reward lies, where the agendas are aligned, whether it's on the security side or the migration front. And yeah, obviously the countries that are seeing the rewards are seeing their policies line up, are being rewarded from further inflows and lower bond yields and spreads, etc. in the markets.
Yeah, I mean, you can easily see how, from a US security point of view, whoever's president and whatever you think of the president, the Chinese building the Port of Chiclayo in Peru, building basically the biggest port on the eastern seaboard of the Pacific. That's got to be a risk. It's got to be something you pay attention to. Greg, I'm going to come to you in a second, but before I do, just quickly, Jared, as an American, as you are, I believe.
Yep.
I mean, how does this all look? Do you find let's put it another way, do you find yourself in some sense having to, not asking your personal politics, but having to defend the US when you are talking to people outside the US, when you're talking either to asset owners or indeed to people like the issuers represented here?
Yeah, thanks, Chris. So by perspective, I am the only U.S.-born person on my team. We got two other now U.S. citizens, but they got their passports later in life. When I go on the road, it's to your point. These can be very polarizing issues. So I try not to take a stance one way or the other and just kind of look. It is what it is. Like as we kind of touched upon earlier, it benefits some. It hurts others, and there's no point in arguing or defending whether you agree with it or not. Just trying to understand where the direction of travel is going. And I think for markets, this is important because it's more stimulative. I think they want ahead of the midterms fiscal stimulus. They're trying to monkey around with credit. Make it more accessible. And I think, front end rates will probably go lower. I mean, we talked about Warsh, but, given all the rhetoric towards Powell, Trump wouldn't pick a guy who he didn't think was going to cut rates sooner rather than later. So all these reasons, I think, boost risky assets globally for now. And then the question is 2-3 years down the road, did we overdo it? And that's something we'll have to figure out at some point later.
Sure. And Greg, I'm going to bring you in here because Jared has just mentioned the sort of practical impacts on a day-to-day basis. Now, I held up one of your bond prospectuses a moment ago. You're having to write prospectuses and documentation which governs potentially something that's going to happen in 2056. There's an awful lot of water to go under a lot of bridges between now and 2056. It is the kind of political instability and the difficulty even to see around the corner, let alone into the future, making it harder to do your job. I mean, you've got, your phrase, which I like, is you're the letters versus the numbers. I mean, you've got tariffs and sanctions and all those things with practical effects on doing business. The investors can sell whenever they like. The bankers on to the next trade the following day. But, the documentation is there forever. So talk us through some of the implications of what we all know is happening on your job.
It is interesting as we talk about, the Donroe Doctrine, Monroe Doctrine, so going back to 1823, right? And so that's the original Monroe Doctrine, which is the U.S. will stay out of European affairs, but will, preserve for itself affairs in the Americas. That is, that's certainly come back. But it's when you look at something that came in, in 1823, and you mention a transaction that's going to mature in 2056, you've got to take a very long-term view. And I think from the lawyers, from the, as we say, the letters, not the numbers, there are two sides really when it comes in. There's during the execution, right? And so you've got the risk of, a T+3, T+5, whatever the settlement period is, what could happen between the trade date and the closing date? And what does that do? These underwriting arrangements typically have banks have certain outs that they can exercise, pre-closing. And then there's the disclosure side, as you mentioned, right? What do you put in the prospectus? How do you draft around when you've got at least a US president who very actively uses social media to announce new policies? How do you address that in the documentation? The other side of that, though, as you mentioned, a long-dated bond, how do you work into the documentation protections? How do you future-proof? And that comes mostly into the covenants, right? Where you have covenants which are written, let's say in 2025, 2026, wherever it might be, which have to survive until, as you mentioned, 2056. So what do you do for the covenants in a 30-year bond or longer to make it future-proof? And one of the things I think that we've seen with the Trump administration, more so than previous administrations, is how much those documents are being tested. And ultimately, they're really only tested when a sovereign gets in trouble, right? And when times are good, you rarely look at the covenants. But in the rare instance when a sovereign has difficulties, that's when they're examined more closely. And so, what have you done in the documentation package? Not just the representations warranties, which typically last only till closing, but in the covenants that go forward to address unknown risks. And some of the work that we've been doing, certainly in the past couple of years, is future-proofing or attempting to future-proof covenants. It comes less, I think, in bond transactions, more so in project finance and others where there's greater volatility. But it's an issue. And how do you future-proof for unforeseeable events?
And of course, international bonds are generally written under either US or English law. But as we're going to come on to talk about in some detail, domestic and local currency bonds are not. I mean, does that provide a challenge for international investors just from that simple point of view, that legal jurisdiction concern?
From a legal point of view, it does not at original issuance when things are rosy and when things are well, but later on in the case of refinancing or worse, a restructuring, to try and herd those cats, if you will. If everything was under New York law or under English law, things would be easier. But you now have sovereigns with a number of obligations under Chinese law, a number of obligations under local law, which I think we saw in the financial crisis. Some sovereigns took advantage of the opportunity to change their local law to try and skirt around some of the restructuring attempts. And then we also have, we've mentioned this last year, the New York State Assembly, it's now in the New York State Senate, an attempt, if you will, to rewrite sovereign restructurings as a matter of New York law. And whether that's a good idea or a bad idea can be debated, but it does bring in a certain amount of uncertainty even within New York law that investors are taking a look at in extreme circumstances.
Sure. Somebody wanted to come in just then, or one of the investors, I think.
Yeah, no, I was going to ask because you touched upon something interesting, and it made me think about Venezuela and the Lee Buchheit arguments about modifications to reserve matters, et cetera, in terms of like future proofing. Or do you have an opinion on how likely investors are to come together to address structural efficiencies 20 years from now, or whatever the circumstances may be, versus today, and the complexities on that? Because just something, since we got a lawyer on the line, I might as well take advantage of it. So.
Yeah, and it's actually free this time. So
yeah.
Well, just send your addresses. I can take care of that.
Yeah, we'll see the quality of the.
You get what you pay for. But the point there, and Lee does make a lot of good points. That I remember the first time I dealt with the restructuring was when I was still a banker before going to law school, and this was late 80s, early 90s, and it was relatively easy, where to restructure and refinance when the Paris Club was so dominant. And you could have somebody like Jerry Corrigan at the New York Fed call up the different banks and force them into restructurings, refinancings. Jerry Corrigan's not there anymore. And so you now have what's not just the Paris Club, you've got Chinese lenders, which tend to be less transparent about their bond terms. You've got private lenders which come in, which tend to be a little more aggressive and less control, but you can't again have a Jerry Corrigan saying, you private lenders must do the following or else. And then you've got the local governing law instruments, and how do you bring those in when again the governments of those nations can change the rules along the way, like we saw in the financial crisis. So restructurings and refinancings are a lot more difficult today than they were in the 80s and the 90s when Latin America went through, country by country was tested. It's a lot more difficult.
Okay. Anybody else want to ask a question or make a point on that? Because I've time to move on to another topic.
No, Christian, I want to make a point.
Please, Joaquin. Yes.
As you know, can you hear me?
Yes. Well, yes.
As you know, Uruguay is a very small country, so this geopolitical context is kind of given to us. But it's also an opportunity to seek diversification, for example, Swiss market, and for example, make improvements in the local currency market. So we see this volatility and geopolitical changes as an opportunity to try to get these goals.
So it's fertile ground for you. I was going to turn to the four sovereigns next anyway, as the sort of second part of our conversation, and we'll stick with you, Joaquin, to begin with, just to look at what you've been doing, more to the point, what you have actually literally just done or are about to do, and just introduce, but in the case of Uruguay, this is a pretty big year, isn't it? Because of course you famously did the one of the original SLBs. I mean, Chile did the one first, but you came second. It was the first one with biodiversity in its KPIs, I think. The first one that is formally verified by the UN, is that correct?
The SLB verification, you mean? Yes, made by Payno, yes.
But but this is the year, isn't it, when the KPI?
No, next year will be a major point in time, because the close data from 2025 will be published, and investor will know if SLB coupon will step up, step down, or remain unchanged. So next year will be a major reporting.
And you must obviously be planning for contingencies to do with that in terms of step up, step down.
Well, at this moment, the data is unknown. I mean, I cannot tell you, anticipate anything, but it's unknown for the moment.
I guess if you were to answer my question, that would be market moving information. So I can understand why you wouldn't, even if you did know. But you have been in as you just mentioned, kind of never waste a good crisis. You've been pretty busy in building out your local currency markets. Why don't you tell us a little bit about what you're doing in terms of things like coordinating with the central bank, whether you might consider a global, local, a glocal, an international peso issue? Tell us a little bit about where you are. Give us your sort of 2-minute case study on local currency markets.
Okay, Christian. Well, in general terms, it's crucial for a debt management unit to the ability to adapt and anticipate macro changes that affect investor demand. For example, in Uruguay in recent years, inflation and inflation expectations has gone down, while exchange rate has have a certain stability. Given this context, the debt management unit has shifted issuance toward nominal peso bonds and reduce index bonds like CPI or nominal wage linked. We also increase issue volumes in a strategical point of the curve, and we have gained more flexible liability management operations due to, as you mentioned, a close coordination with central bank. For example, we accept as an exchange method of payment the central bank bills in local issuance and in global issuance like we did last year. Also, like in October of last year, we started to publish a monthly report of local market issuance that has been very well received by local investors.
And what's the international participation currently in your local market in terms of percentage?
A very good question. It's near 0% in local market, but it's okay. Despite these developments, as I said, foreign investor participation remain low, but efforts will continue toward establishing, Herman want to say, enable conditions to attract foreign investor to local market. For example, we are exchanges with Euroclear are ongoing, and also we have an aspiration as an office to include a local peso denominated bond in the GBI index of JP Morgan. So we are pursuing these enable conditions to attract foreign investors to local market, to our law in Uruguay.
So you aim to have local currency instruments euro clearable?
Yes, I mean, it's a long-term goal, but the conversation are ongoing, and well, we see Euroclear as nowadays we have the channels, we have CDNs, and we have Clearstream, so foreign investors can buy local domestic bonds, but we see as enable conditions both index and Euroclear for the medium-term future.
Okay, thanks, Joaquin. So I'll ask the investors in a moment or two why they aren't buying Joaquin's bonds, his local bond. But I want to hear from each of the issuers first. So Daniel, from one of the smaller countries to the biggest, we'll come on to do a very recent transaction in a second, but you did, it seems to me, rather more hard currency funding last year than you have done for a number of years. That's correct, isn't it?
Yes, it is. I think last year, actually start maybe on 2024, we changed our long-term goal on the hard currency on composition of the public debt from 5 to 7%. We closed last year at 3.8, but that was a lot of because of BRL appreciation as well. And last year was, I think, the hugest towers that we had in the next years. But we changed that. We saw the advantage to increase the hard currencies, that you can extend duration to have a closer contact with external investors, and then this relationship will try to bring them to the local market where we really fund ourselves. So last year we did, I think, was $10.8 billion
All in dollars, right?
All in dollars,
dollars.
yeah, across 4 transactions. Last time that we did 4 transactions was back on 2010.
Yeah.
So I think the average for the past decade was around 1.5. I know that it's below 2 transactions a year, and last year we did 4, and that's a continuation of the path. This year, the strategy is to do at least the same amount in dollars, and then to explore other currencies as well. So we just did the transactions. I cannot comment a lot on that because it was just done.
Yeah.
But hopefully we would have a good market to increase that as well.
I'm sure it'll be. I look forward to reading the write-ups tomorrow. But you didn't quite have a record tight spread over treasuries on your big deal, your $2.5 billion 30-year, did you? Or was it that you were almost 187 basis points over treasuries? That's a pretty tight spread.
Yes, we have been experiencing the tightest spreads for some time now, since I think we are in the best environment since we lost investment grade back on 2016. So we see the appeal of investors, the demand that they have towards Brazil credit, and we were able to squeeze as much as basis points as we could.
Yeah, no, it's quite remarkable and well done to all of you. But the obvious question is, well, apart from availability, there's plenty of demand.
Yeah,
we talked before. We talked on these kind of calls before about the increase from 5 to 7 in hard currency. But the short question is why? I mean, obviously, it's the usual stuff about establishing a yield curve for other Brazilian borrowers and so on. But what are the primary drivers for? You don't need these bonds. You don't need these investors. So why do you go for them?
I think we have a long-term goal that was a study that we have here in the middle office that establish how much do we want in the composition of public debt. So we have hard currencies, we have fixed rate, floating, and inflation linked. And with when you balance cost and risk, we came up with this 7% that was the long-term target. Actually, we don't really need. We can fund ourselves in the local market. That is a very deep and liquid one that we were able to do every year. But then you lost some qualitative advantage to go to the external market. And also, we understood that in the past, we did only to have a reference for companies to fund themselves. And I think that came because in the past, Brazil always struggled with external debt. So all the shocks, we have the default back on the 80s, and then we went to a path to decrease the participation of hard currency from maybe 40 to 50% back on 2002 to 4% that we end up last year. But we saw that maybe we went to 4. I think there's a lot of room and advantage to increase that a little bit. So you get the benefit of costs. You get the benefits to being the index that talks to external investors, and then maybe we can bring them to Brazil and increase the participations as we did back on 2015. I think the foreigners in the public debt was around 20%, and now we have close to 10. So that shows that the advantage when they come to the local market, we get the benefits to have a more stable fixed rate curve on the local market. And the first step is to go to the external issuances.
Yeah, and was the latest issuance was a sustainable? I know the November one was.
Yeah.
So you're still. We'll talk a lot more to Victor about this, but you're still convinced of the idea of thematic or labeled bonds.
We continue with the program that we start back on 2023.
Yeah.
So we have done 3 issues already, so once a year. We split them in environmental and social. 60% is environmental and 40 up to 40 on social. We just approved the expenditures for the first transactions back on November last year. I think we are going to continue the program. We see the advantage, we see the appeal of the investors, and Brazil is always trying to position himself as a sustainable country. So we have a program regarding energy transitions to clean energy. We already have, I think, probably the cleanest energy source in the world. So we have most of them is I think around 70% is clean. So this gives us the advertise that we want to show investors that Brazil could be leading, or at least one of the leaders on this ecological transformation.
Oh, obviously with hosting COP and so on as well last year.
Yeah.
So thank you very much. We'll come back to you again a bit later on, because I didn't ask you about currencies. But Paula, as we have become used to seeing, Mexico, United Mexican States, was first out in 2026, and it just so happened that it was a record, wasn't it? You issued 9 billion in a day, if I'm not mistaken, and you increased it during the syndication process from 7 billion. So that was pretty successful. I bet there were some champagne corks popping in SHCP that night.
Yes, we're really happy about the issues that we have last year. I think we have records. We have really interesting structures like the PCAPs also, that it's a really interesting different approach for the debt markets. Taken all together, the Mexico last year operation represent an historic execution. It had a combined volume between euros and dollars and everything of $40 billion. So of which 12.7 billion corresponds to the new financing line with previous years. And we also cover the 80% of the UMS debt ceiling and the remaining amount of that year in 2026 issuance. So we did also liability management exercises that help us reduce 80% of the debt for 2026 in the external markets.
I mean, the investors will be very conscious of the Pemex question, and Pemex is a potential liability upon the state. I know you can't say too much about it because it's not your specialist area, but the PCAP bonds were a success. Will we see more of those? Perhaps, in fact, just for the benefit of those who don't know, you might just give a word of explanation about what the PCAP bonds were.
Yes, the PCAPs are a structure that was designed with a relatively short average life and a disciplined amortization schedule. The amortization begins in August 2027 with 40% of the outstanding principal, and followed by the largest payment in 2028 for 43%. What is important of this is a risk management tool to address, and it was used to address Pemex near-term financing needs under a really transparent transaction. We placed approximately $12 billion in 2030, more or less the maturity. And the most important thing about this is the procedures were used for a special purpose vehicle, the Eagle funding. And what was the objective for having the 12 billion? So we can acquire highly liquid assets. In this case, were U.S. Treasuries and Treasury stripes. And that same assets will serve as a collateral and are redeemed at maturity, allowing long-dated financing under attractive terms while managing balance sheet and funding cost efficiently. That was like the main structure of that.
And although I said 9 billion was the record, obviously you just mentioned 12 billion, but that was not a straightforward global bond issue. So 9 billion.
Yes, it's straightforward. It was 9, but regarding this instrument it was 12.
Yeah.
And I think it was one of the biggest in Latin America of that structure, that kind of structure in America.
Well, we'll ask our three investors to comment on that in a moment. But first of all, I want to hear from our fourth sovereign, Victor. As I already mentioned, I mean, you have been incredibly wedded to all kinds of label bonds, biodiversity, social, sustainable, sustainability linked. And as you said, 40% of your debt stock is now in those types of thematic bonds. Just one small question about your most recent one. You adopted the step up, step down structure, which Uruguay, I think, had done first. Did you look at their example and think it looked like a good idea, Victor?
Yes, actually, not only a good idea, sometimes the step down is better to align incentives. Internally, we have a transition to a new administration, so we had election during this year. So sometimes in order to make it clear and to align the incentives for the new administration, instead of putting a penalty for not complying with certain targets, it's better to put an incentive. It's quietly more attractive to say, okay, will be a diminish of the percentage point in the coupon instead of you have to pay more. So yes, we looked at example of Uruguay. Certainly, it was a good deal. The investor community received it well. There was certain question regarding the step down, but certainly was not a material issue in this regard.
Okay, good. And you see, I mean, obviously, globally, there has been a little bit of a dip in terms of people's interest in either issuing or buying labeled bonds, ESG bonds of one kind or another. I mean, and you know, not entirely divorced from our second question number two, ring the bell, Mr. Trump, symbolizing a whole global movement, not just one guy. There's been definitely a diminution in people's allocation to those kinds of instruments, but that certainly hasn't stopped you. So I mean, in your most recent transaction, did you get new accounts you hadn't seen before? Did you get surprising accounts, surprising geographies? Tell us a little bit about the demographics of the investor base for these papers.
Yeah, first of all, to mention that despite what's happening in the US, the demand and the interest in the ESG scope has not been very different during the last year, and perhaps going back to the geopolitical issues, sometimes we feel more noise, but the structural trends are the same. So I feel that in the case of the ESG market, obviously there is a lot of noise, boys, and contrary of that. But the interest from the investor community, at least during the last 5-10 years, I see that there is an increase every year. So in the case of the SLB could be complicated because we had, or the market has had certain bad experience regarding the greenwashing and so on. And obviously, what we have seen in the last year is that the market is more sophisticated. It certainly cares about the greenwashing, and the greenwashing is a super bad word in the market. And in the case of the SLB, there was a lot of bad experiences in the corporate sector. So in this regard, it could be complicated to convince the market again. But we felt that when issuing to the SLB product, it was not much related with the characteristic of the bond itself. It was more related with the characteristic of the country, the storytelling, the commitment, and so on. So going back to your question, it's interesting to know and when we see the book of the 2 euros, because we issued an SLB euro along with a vanilla euro. So it was a very good example to compare both cases. First of all, the investors were a little bit different. So it seems that there is a batch of investors that are really interested to participate in the SLB. Secondly, the demand in the SLB euro was higher in comparison to the other. Obviously, the comparison is not the same because the maturity is different and so on. But there is good proxies that speak about that the SLB perhaps had certain good features in order to market very well in comparison to the vanilla.
But it's interesting that you're saying that people are buying it because it's Chile, not because of its particular characteristics as well. But I mean, one of your KPIs, I think, is to have a certain proportion of the territory of Chile under sort of legal protection, ecological?
No, with the characteristic of Chile, I meant that the ESG story of Chile was attractive because we have been consistent in this regard. Obviously, we care about the greenwashing, we report very well in this regard. When the ESG information that is provided to the market is good, certainly there are less questions about that.
Okay, no, sorry, yes, I misrepresented what you were saying. But tell us about this 30% of the territory of Chile that has to be under official protection.
Yeah.
It's a KPI, isn't it? How are they going to measure that? And who's going to measure it?
Well, first of all, it arises from certain international agreements that go in Montreal, so it's not a weird thing. It's certainly signed by many countries. It will be measured through the Ministry of Environment system, roughly speaking. So there will be a sort of reporting, but the interesting thing that the reporting will be checked by the internal entities that are in charge of the commitment of this regard. So this is a very useful cross and check in order to verify the final amount. And along with that, very important in the case of Chile, because we have had certain bad experience in the world regarding the protection. So many countries sometimes say, okay, there is a protection, but what's the real protection is not very clear. So in this regard, we included an indicator related to the good management of the territory. And along with the typical reporting saying, okay, we have certain degree of protection, there will be certain measurements, for example, regarding to the existence of camera traps, bodyguards, and so on. And very important, there will be an audit process. So the typical audit will be established in this regard in order to verify that we are actually complying with the target.
Okay, good. Thank you, Victor. Now we've got three PMs who I'm sure they're all bursting to say something to what they've just heard from the four of you sovereigns. Who wants to go first? Turn your microphone on. Come.
Maybe I can start.
Yeah, please, Gary.
Yeah, so we would agree with, I think as mentioned by Victor, the holistic package on the ESG side is important rather than just the specific bond deal and use of proceeds, etc. But we are very much in support of those use of proceeds bonds and targeted bonds per se, given that they tend to show obviously a commitment, a longer term commitment to a certain cause across future administrations that kind of tie them to these certain variables that are included in the KPIs, etc. So we think that's important, and it also shows this cross-ministerial kind of working flow as well across the government towards those targets. So it's certainly something that we're very supportive of, but we also understand with the lack of premium now on offer for issuing in this way against a normal conventional bond, and that money's fungible, obviously it becomes less appealing for certain issuers to issue under this way. But certainly from our investor base, there is still large demand for these type of issues, and any type of issues that start to come into the realm of the kind of transition assets, etc. as well. There's a new pool of capital waiting to invest in these type of assets.
And I back to the point about the sort of investor demographics, which comes first? I mean, obviously it's chicken and egg, but is it somebody who's interested in Latin America who gives you a mandate to buy Latin American sovereign bonds, or somebody who's interested in ESG bonds who you then say, hey, have you thought about Latin America? Do you see the distinction?
It's a bit of both, I would say. Yeah, there are certain mandates which will have specific investment guidelines around ESG characteristics per se, or use of proceeds. So they would be more probably global focused in our experience rather than specifically to the Latin American region. But certainly it can come in all different shapes and sizes. But we just know from experience that there are, and what we've experienced, there are certain managers and asset owners out there that do have demand for these certain types of bonds rather than your conventional type of issuances.
All right, good, thank you. Khan, people keep dotting on and off my screen, but I assume everybody's still there until they don't reply. Khan, just on Chile quickly, do you see any concerns at all about the new government? It's quite a different government from the last government. Obviously, I wasn't going to ask Victor about that, but it is as plain as the nose on your face that the new president is very much not the old president. So quick comment on that, and then perhaps you can give us your thoughts on one of the other issuers here, or what they have said to us.
Yeah, absolutely. I mean, obviously, it's a big shift. We are, watching the developments, as well as we can from the outside. One very prominent theme in Chile is that there's a very large backlog of investments plans that haven't materialized, and I won't go into the politics of it, but the previous administration gets blamed, for it. And there is, it's a huge number, $93 billion, worth. There's, some commentary that a lot of the investment prior has been very focused on copper, but there are other areas, to expand investment. I mean, we're talking about 25% of GDP in, projects to come. Is my microphone okay? By the way?
It's fine. It's good now. It's
okay,
on your other ear. So.
Yes, just checking. I don't know what happened. This part of my mouth works better. Certainly that's a big theme that would, if we get more progress in that would certainly be very good for the economy. One thing I'm curious, also having Victor here, is I think the long-term issuance has come down in 2025 versus medium-term, issuance, and I'm assuming that was more the yields, globally. But I'm just wondering how that will change in 2026 as we get, we will discuss the Fed later, but we'll have lower rates globally. Fingers crossed. On the other issuers, certainly welcome Uruguay's plans. Perhaps one thing that we are currently paying a lot of attention to is the currency debate. In the country, so for us, we have been able to get involved in the global issuances in Uruguay, because we do have some accounts that do Clearstream, but predominantly the accounts that we run do Euroclear. So it would certainly be a forward step to have the local bonds clearable. But indeed, currently we are focused on the very near term, focused on what happens with the currency, given that some sectors like the agricultural sector have some serious complaints about the level of that, and that of course could affect the appetite for any sort of near term issuance, because obviously the yields are actually not that low, that what we've seen in the issuances for Uruguay's rating, but obviously the currency direction will have an impact there. So that would be my comments. Maybe just two sentences on Mexico. I think Paula made a great statement. I think crises will be there. It's more about how you cope with the crisis, and I think Mexico has done a terrific job. I would think cap
structure has been successful from an investor's point of view.
I think so. I think it was a very smart way of helping Pemex with the liabilities without having any causing any sort of rating issues, and allowing this financing under Mexico's investment grade rating, and really relieving the company. And if you look at how the spreads of Pemex have done last year, it's been phenomenal, and it's been showing. Of course, the question would be, I don't think it will be a regular thing. I could see another deal, probably won't see two deals, given that at some point, the rating agencies will have a closer look at it. Having said that, I think for rating agencies, they consider Pemex debt as part of the sovereign balance sheet already. So the fact that now it's moving to cheaper options, still doesn't change. In fact, enhances the situation. Yeah.
Yes, exactly. I think the pickup was a really necessary strategy, not the cheapest one for us. So that's something that we have to see other structures that are cheaper that were necessary, but it's not exactly the cheapest one for us. And as you were saying, following the implementation, the credit risk perception improved significantly in Pemex. Even we thought that maybe the UMS curve could get a little bit stressed over the oversupply that we were going to give, and surprisingly not. It was pretty steady, and Pemex curve went down, so the spreads compress and in a really positive way, not exactly with UMS going up the curve, and that show us that investors were really on board for the situation and giving clarity and transparency of the efforts of the conjunction efforts of Pemex and the Ministry of Finance. And obviously, what is really important is that we could see a rating upgrade by Fitch and Moody's that also improve a lot the perspective of the investors. We from now we are going to issue Pemex in pesos, and it's the first time Pemex is going to be in the market since 2019, and this Friday, 13. So it's going to be a breakthrough issuance because it's the first time Pemex will go out to the market again. It will be in local currency, but it will set a precedent that after all the help that was made last year, how the investors will react to the IPTs that are already released and how the participation is going to be, regarding that now Pemex can go it's by itself. It's going to be used, the proceeds is going to be used to pay debt of that year on pesos, but still it's a groundbreaking thing. And after that results, we can see what's next for.
So finally, this sort of, everybody is always like Mexico, mad Mexico, but there was this sort of black cloud on the horizon that was Pemex. We can now say that cloud is being dispelled. So
yes,
that's a good thing. Jared, comment by all means on what you've heard from others.
Yeah.
I also want you to turn the conversation a little bit to some of the countries we don't have represented here. I mean, Ecuador, of course, suddenly came back to the market with a very successful transaction 11 days ago. Got a double upgrade from Moody's, and generally were thought to be behaving extremely well. I mean, obviously the lending is only to take out the bonds that were restructured post 2020. But what did you think of the Ecuador trade? And then we're going to speak about Argentina, and probably others will want to talk about Argentina too.
Yeah, well, let me respond, because I think the other speaker said something pretty interesting, and I'll transition to Ecuador. So for Joaquin's comments on Uruguay, we did Uruguay Globals last year. I think it was one of the best trades we did do. And you mentioned GDNs and the liquidity with the local market. And as you mentioned, there's pros and cons to this, but Uruguay's, a small country between two larger ones. And one of the things that unfortunately goes with smaller countries is, it doesn't make sense to issue very large issue sizes in debt. So I've actually sniffed around trying to buy local paper in the past, but trying to find a pension or insurance company, especially on a Friday afternoon, to sell you some bonds, it's impossible, right? GDN structures are great if you don't have the global option, but there's additional fees that are paid, right? So if you can't get local custody or global, then GDNs can be an alternative, but it's just too many middlemen sometimes. So maybe not the most effective solution. Daniel's comment got me thinking too about issuing at record spreads. Having said that, looking at the deals you're doing today versus the deals you're doing 5-6 years ago, all in yield, and this is something that's on everyone's mind, right? Yield versus spread. What matters for the end total investor? What matters to the issuer? Spreads are tight. Yields are not as high as they were a year or two ago, but they're still reasonably high by historical standards. So it's interesting to hear just a little bit. I mean, no one can predict what's going to happen with treasuries in the future, so how people think about this. But, part of the reasons why emerging market debt right now in the cycle, at least from the clients and the prospects that I talk to, is tied to the high total return potential for investors given the yields are high. The Pemex, the PCAPs, very supportive of the transaction. I thought it was a great deal for both. It was interesting to hear that there might have been more cost-effective ways, but part of the story, at least that I've heard for this over the decade plus, is there's significant domestic legal hurdles that prevent certain things that might be from our side, like, hey, why are you not doing this? And the answer is, well, we can't. It's against the law. But I think there's been a lot of EM dedicated investors who are strong believers in the Pemex trade and the fact that it's money good. But it's also when I was talking to an asset allocator in Canada, and I said, he said, what do you do? I was like, we manage an MB Global Diversified benchmarked fund. He goes, let me guess, you're overweight Pemex. It's like it's became such a consensus trade, and it was the crossover guys, and you really saw that price action change post 2018, post downgrade, and you can see the impact of just given the amount of debt that was issued and what that means for pricing versus the sovereign, right? And the other thought that I had was, in response to Victor's comments, and Gary kind of talked about this a little bit. So I had I listened to a former colleague of mine speak on a different panel like a year or two ago. And for the SLBs, there is definitely a different supply and demand technical. And I think at some point, Chile has issued so many, green bonds, et cetera. You end up paying more a little bit for those than versus the non, green curve. And I think it'd be curious if, I don't know if anyone is allowed to comment on this, is if doing a green bond doesn't save the issuer money, do you still want to do it? Do you want to do less of it? Do you want to do more of it? I mean, it's to me, that's an interesting angle to all this. But and transitioning a bit to your point on Ecuador, and yeah, things are looking good in Ecuador. To the points we talked about, the Don Road doctrine, and who the U.S. administration's friends are in Latin America. Ecuador is one of them.
Yeah,
I was told. Yeah, RFK Jr. I think is Noboa's godfather. And you notice there was like 3 guys from Latin America who were at Trump's inauguration. Noboa was one of them, right? So if you are, and I've heard some comments, and if you're a believer of this, I certainly am, that if you are a friend of this administration, they want to help you. And so I think that, plus the point we made earlier, just about credit spreads being tight globally, is kind of what's led to this big spread compression. You've seen that's a lot of these similar comments, also are in play in Argentina. Friend of the administration, they're doing the right things, and credit spreads and risk appetite is high. And for Ecuador and Argentina in particular, by no means is this my near-term base case, but if you do get a big change in global risk appetite, what do those credit spreads look like? Because I'm of the opinion that right now everything looks good. We're going to have lots of stimulus globally, especially ahead of the U.S. midterm with pressure on rates, fiscal, etc. So I think we are in a risk-on environment for the short to medium term. But I don't know what that looks like 2-3 years down the road, and that's something that's been weighing on my mind a little bit, because it's always hard to figure out when the turning point is going to be. No one can do it. Everyone thinks they can. But being prepared for that point in time is I think something we're very conscious of in our fund. So.
Yeah, well, you're looking at the guy who on Thursday night the week before last bought some gold and some silver.
Yeah. Yeah, market timing is not so
not a huge amount, but I really must learn not to try and invest my own money. Thanks very much for that, Greg. A couple of points from what Janice just said that bring me back to you. First one about defaulters. Everybody's well disposed towards Argentina generally. Most people on Wall Street, a lot of bankers, of course, are from Argentina. But most people have been there and enjoyed the city of Buenos Aires and all the rest of it. And not to say that there aren't other charming and lovely cities in Latin America, but people, generally speaking, want Argentina to come back one way or another, despite their fairly clear record of not being the most reliable investment. From a legal point of view, could they come? I mean, everybody's talking as though they'll be in the market, next week. But how do they work themselves out of their default position to get back into the market? Purely from a legal point of view, there must be hurdles to be jumped.
Well, I don't want to speak specifically about any country because of just internal issues, but I would say that having a friend in the Trump administration, which clearly they do, and other countries do, helps significantly. We see in other countries that the U.S. has taken very creative, under the Trump administration, has taken very creative paths to help the countries. I'm thinking, so for example, one of the funds in Qatar that has been established for one of the countries. So I think having friends within the U.S. administration and making those inways always helps. I think, to get to Jared's point, one of my colleagues say that traditionally Washington has been a city of 10,000 doors, and you need to know which one of those 10,000 doors to walk in. Today, people say it's a city of 5 doors, and you have to walk in the right of those 5 doors. And so certainly anything, the Trump administration is highly transactional. And to the extent that countries want to work with the U.S., the Trump administration is open for negotiation, open for business.
Okay. Well, nicely dodged that particular question. Fair enough. There is a question in the questions on my other screen, which is a question directed at you, but I'm not going to ask you because it begins with a V. So the relevance of the question I'm about to ask Greg will become, I hope, clear in a moment. But Greg, you were involved in the US-Ukraine critical minerals negotiations. Now, one thing which raises its head as a topic in all OMFIF capital markets panels these days, in Europe especially, is how do we fund defense? Growing defense needs, security, rearmament, blah, 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 costs a lot of money. Now, Latin America, generally speaking, is in a fortunate position of really being largely removed from those kinds of issues. I think it's fair to say, probably the least likely part of the world to have a country-to-country war. Nonetheless, by proxy, it is affected because Americans, want control of minerals, and Latin America has a lot of minerals, and China dominates to up to 90% many mineral sources in the world, as we all know, and that's clearly not something the US is ever going to be happy with. So they've pumped up by double, I think, the capital in the Development Finance Corporation, and are starting to spend that on mines and so on. Even Exim, I was reading today, Exim has just financed, US Exim has just financed $200 million for a tin mine in Cornwall. For those of you who don't know, that's the sharp, pointy bit on the bottom left of England. So they're certainly spreading the dollars around. So I want you to come on to that topic, Greg, because you're intimately acquainted with it. But first of all, just give us a picture of what the Ukraine-US negotiations were like, and how does that give us a pointer to what the US might be doing with DFC or other funds into Latin America. So I hope that all hangs together, right? Initially, Ukraine seems very irrelevant, but you take my point, I'm sure.
It's not irrelevant. One of the aspects of that when I represented U.S. Treasury and DFC in the U.S. Ukraine was, first of all, how strong and how competent U.S. Treasury and the DFC are. Right, that's what I think most impressed me. How transactional they can be, and part of the U.S. Ukraine Reconstruction Fund was U.S. investment allocations towards Ukraine industry as part of the funding of that fund. I can't go into too many details because I don't know to what extent the documentation has been made very public. But what it did show is that the US was very, very interested, obviously, in the critical minerals of Ukraine. One of the issues with Ukraine is that a lot of the maps, of minerals maps, are from the Soviet era and not necessarily reliable. But what it led to, and back to Latin America, is showed the US's and the Trump administration's desire to use the DFC as a tool of policy. The Trump administration, the first Trump administration, largely created the DFC out of OPIC and some other bits and pieces of the US government. And the Trump administration wanted to strengthen the DFC as its own sort of, if you will, private equity fund for US strategic purposes, as opposed to concessional lending, what have you, around the world. And so the DFC's authorization ended in October. It was reauthorized in mid-December. It was actually a tripling of capital, I think in excess of $200 billion. And the way it was worked out between the different committees is that while most funding is only available to countries which are not in the 20 largest economies, certain aspects like critical minerals are available for investment in any country. And so you see that the US is using the DFC around the world, but specifically in Latin America, to make investments in areas of interest in critical minerals. You've already seen a number of transactions taking place in Latin America, go country by country. To what extent is that being used just for critical minerals gathering? To what extent is it being used somewhat to influence politics in the region is a different question. But I think the overall picture is that the DFC is going to be a critical part of the US government's means of securing critical minerals in the Americas. And where that comes up against Chinese investment in those same critical minerals will be an interesting aspect of 26 and 27.
Yeah, for sure. But I mean, it does show also that the region has something that the US wants and needs, because the current dominance of China in the supply chain is obviously intolerable. Although I did notice that Brazil has most of the world's reserves of a thing I'd never heard of before, which is called niobium, which is very useful in superconductive magnets. I'm sure you all knew that. I didn't. Let me go back to a couple of investors, and then we're absolutely going to go back to the crunchy food and drink of the day-to-day of the bond markets. So, Gary, we talked about the sort of wish for the US or current US administration just to kind of wield a bigger stick in Latin America. But what about things like actual official investment flows and things like that? I mean, it's fair to say that, I started going to Latin America in '92. Everybody thought that Uncle Sam was the friend and the investment would come from. And of course, even at that stage, it was beginning to change. It's fair to say that the US has probably, to its detriment, ignored Latin America for too long. But what do you think of that? And what do you think about the actual divergence of funds rather than just sort of blowhard rhetoric?
Yeah, so I think away from the kind of financial market flows, was the trade deals and relationships with the US administration and almost consistency of policy that we're now seeing from the macro side and between administrations in Latin America will help that kind of long-term flows start to come back to certain countries in the region. Certainly Latin America has a lot of what the world needs, as you mentioned, in terms of the commodities and that kind of pathway into the US market as well. So I think where we do expect to see flows will be from the US kind of downwards into Latin America, and that will be encouraged by the Trump administration into certain countries where they are obviously strongly tied or friendly with these administrations. We could see it in like Argentina, for example, into the Vaca Muerta. You can see investments there from the oil and gas majors into those type of projects, and even into countries like Ecuador as well, where they obviously have globally important ports, etc., into Latin America and outwards to Asia. So I think we will start to see the kind of material impact of the change in policy from the US into these countries over the coming years, especially where focus has now been centered on security, etc., and there's rising confidence in investing in these markets. So we can talk on an example like El Salvador, where the security situation is massively improved under the Bukele administration, and now we're starting to look at El Salvador as in terms of when they're going to start receiving foreign direct investment, whether it's in ports or into other sectors, which a few years ago was unimaginable given the kind of hold on the economy that the gangs had. So yeah, I think that's certainly what we're focused on in the near term and the medium term.
Jared, obviously people worry and sort of get a bit uneasy about political pressure from north heading south. But the fact is that US capital will be extremely welcome, whether it comes with a few political strings attached or not. Don't you agree?
Yeah, I mean, yeah, it's. I can't think of a country in Latin America that's saying we have too much investment, please go away. So it's.
No, absolutely. Okay, right. So everything comes back to the US in a sense, because we're now going to talk about rates, which you obviously touched on. But I'd just like to hear from a couple of the issuers. Joaquin, what are you preparing for in terms of rate expectations during 2026, showing my age? What are you preparing for in terms of rate expectations this year?
Well, the expectation is that the decision that Trump made with the new guy from Fed is neutral, I mean, it's not a radical decision. So we expect maybe no changes in the rates, at least in the first half of the year. I don't know on the second.
That's interesting. I mean, who was Jared touched on this earlier on, of course, this sort of yield versus spread. If you did have looser US monetary policy, you could cope with a little bit of spread widening, but you're not starting to make those calculations yet. And let's ask one of the Victor, your Fed expectations. I know, crystal ball stuff about the Fed is everybody's sport and nobody's fun. But what are you planning for? Do you agree with Joaquin that
yes,
rates are steady?
Yes, I agree with Joaquin. Notwithstanding, I think that there are other dynamics that are more important in our case. It's related with some question that was did before. Certainly, we had issued more in the middle term part of the curve. So certainly, and this is an issue for all sovereigns, the long-term part of the curve, especially because of what's happening in US, it's affecting our decisions. Go longer, it's more expensive. In part, it has affected the internal rates. The situation of the pension funds in Chile, especially during the last year, also affected that. It's recovering this year, but I think that this will be a discussion for the sovereigns if they go longer because they want or because they need. In our case, we have still a scope to issue shorter. Our ATM is relatively high in the world, I think. But in the future, perhaps there will be sovereigns that we will have to think more about that.
And if people are looking to issue longer, the local markets are not really so much help, are they? In most countries, the local investors will not tend to buy longer dated paper.
It depends on what we think about longer. In Chile, it's very different because the pension managers participates up to 30 years. So 30 years perhaps a little bit weird in the rest of the world. So we still have a buffer in this regard because we have certain demand assured in those places. In other places, typically our colleagues could say better, but the shorter, it's a little bit shorter, the local market. And typically the US, and it was the case during 2023, 2024, was a sort of a new market in order to get longer when the local market was not enough. Right now, I'm not clear about that.
And Daniel, your thought on rates, but I'm right in thinking, aren't I, that in terms of your longer dated local currency paper, that tends to go more to international accounts than to local? The locals prefer short term. Is that correct?
Yeah. in the local market, the local investors usually stay for up to 4 to 6 years. When you're talking fixed rate notes, they extend durations when we have the inflation linked, and then we have papers up to 40 years, but only on inflation linked. So the fixed rate notes, we issue them up to 10 years, and most of the demand comes from international investors. That was the case actually until last year or maybe the year before, that we experienced a little more of extending duration from locals, but not as much as international investors.
And just what I got you, and we could have mentioned it earlier, but not long after your successful Q4 transactions, there was, of course, quite a severe wobble in Brazilian corporate. I mean, what, from your point of view, drove that? Obviously, it wasn't a good headline, but it didn't affect what you were doing. But what was behind that?
I think was related to specific companies here. There was, I think they were entering in some kind of restructuring that, but there was not impact that much on my funding.
No, I don't think it
strategy.
did at all. But it was notable, the proximity of the two events. So
Yeah.
you're sticking with Victor and Joaquin. No change from the Fed. You're not planning any change. Okay.
Yeah, actually, we might have some maybe one cut or something, but I don't think that would impact the long rates, 10 and 30 years of the US. So they would still materially be unchanged.
All right, Paolo, your expectation, Fed expectation. Mr. Warsh is a bit of an unknown quantity. We'll ask our Americans what they have heard about him in a moment, but what sort of expectations are you working with for the rest of this year?
I think we're going to maintain levels on the steepening of the curve. We're going to maintain in U.S. Treasuries. We're going to maintain the steepness of the curve, and I think the Fed is going to be a little bit cautious, but not in a really hawkish way. So I think at least for this year, we can see rates maintaining, or at least with a little bit more. How can I say? Like they will be looking for new indicatives, if that's what I mean. And I think that is really important after all of the things we're going to see in June and July. And that's something that will transcend for the rest of the year. And I think June and July is key months for the market to see how the year is going to close and the perspectives.
Okay. I mean, that's interesting, you portfolio managers. I mean, all four sovereigns saying the same thing. I'm a bit surprised. I mean, I'm less in the markets minute by minute than any of you, but I would have thought that the president has signaled very loudly he expects rate cuts, wants rate cuts, would see them as a good thing, condemns the current Fed chairman for not providing them. He's hardly going to have nominated somebody who's not going to go along with that, is he? Or is Kevin a contrarian? Who wants to take it first? Jared, yeah.
I'll take that, because I also wanted to comment on something that Victor said that I thought was very interesting. Just take a step back for a second. I think what's really interesting, specifically amongst the dollar curve, is the volatility in interest rates we've had over the last 5-6 years. So a lot of deals that were done in 2020, 21 at very low rates now have very low dollar prices, given how much interest rates have. And this is something, you look at when you're going to do a new 30-year deal. Do I want the existing one at like 60 cents on the dollar? I don't want the new one at par. And I think there's so little risk premium out there. Look at the Ecuador deal that was most recently done. There's so much enthusiasm. You basically printed on top of the curve, despite some very significant dollar price discounts. So it'd be interesting to see if the issuers try and test the waters a bit. Some of these things, like, Colombia, the lower dollar price stuff, it's kind of become like a technical, like the 2051s and 61s. They trade so much inside other parts of the curve for their low dollar price stuff. So I think this will be something really interesting to watch in the next couple of years, is how investors value dollar price. But back to the point you were making on short-term outlook for interest rates. Yeah, I'm of that view. I think I know Governor Myron from school, and I hear a little bit of Eric before his position, what his views are. They haven't changed a whole lot, and I would be surprised if the optics, at least, you don't get a cut. But the other elephant in the room that I think is getting more and more discussion is the balance sheet, right? And there's a bunch of different levers you can pull in this time, to make policy either more accommodative or more restrictive based on what you do with that. I don't disagree with some of the points that the speakers made, and especially there's so much uncertainty and skepticism around the long end of the curve, given some of the I don't know how to phrase this, institutional concerns you might have about the U.S., and they're not unwarranted. But what I don't know the answer to is that kind of in the price already, and I just don't have a view there because there are so many people talking about that. So,
Gary, your response, but also I'd like somebody. I want somebody to talk to me about Argentina, not just to me, to all the 100 people listening. And you might have thought that insofar as Argentina could be made investable, could get away a trade, they might be waiting for a lower interest rate environment, but nobody on this panel at least seems to think that's terribly likely, at least not in the short term. Where are you on this?
Yeah, so on the Fed, I would say not too much to add to what Jared said. I think he made the right points. I think our bias is kind of in line with market consensus. We will see Fed rates lower this year, but then there's a lot of uncertainty and question marks on the balance sheet and how that's used and how coordinated any policy between the Treasury and the Fed would be in future as well. So that's still highly uncertain. But I think for us, we do see rates being still accommodative this year and likely to kind of justify where the markets are pricing for now, the kind of 2 cuts this year. On Argentina,
when's the first?
Mid-year, so not kind of May, June. Say.
Okay.
But for Argentina, I think obviously after the Ecuador deal, the attention quickly shifted to Argentina and kind of who was next. And I think Argentina had the window of opportunity and still do have the window of opportunity open to them to issue. They've clearly stated when they've been approached by different investors and in different public forums that they have alternative sources of funding at cheaper levels that they would much rather tap into at this stage, and they're happy to wait for yield levels and coupon levels to come down. So I think the focus for them is obviously in the upcoming labour reform that they hope to pass in the first half of this year, and to continue on this fiscal consolidation path, which will likely see rates continue to come down. So I think for us, we think the market's open for Argentina, and we would be interested in issuance from Argentina. But for them, they see better options at this point to issue at lower levels and a kind of longer duration as well. And optically, they could construct a similar deal to Ecuador, where they could be buying back kind of shorter duration or shorter tenor bonds and issuing longer dated bonds. Obviously, for them, it's at higher coupon rates as well. So I think for them, the overall funding cost is important, given their fiscal is relatively balanced and it's more rollover financing they need rather than kind of fiscal deficit financing at this stage. So that would be a key consideration. And another one which is obviously open for Ecuador was the ratings upgrade they received last year. So they got themselves back into composite rating of B-, which is important for global investors when you kind of lose a lot of the stigma attached with the CCC rating, and allows access to more global benchmarks. So Argentina are still in the situation where they're CCC rated across. A lot of the rating agencies have kind of contingencies for upgrade on market access, so which we believe is open for Argentina at this stage. Whether they realise it or not is one thing, but it does feel like with market access open to Argentina at the kind of 9% kind of levels on yields, then we could be starting to look at potential rating upgrades in 2026 for Argentina back into the B B minus category, which could obviously lower funding costs or materially from current levels.
Okay. Khan, I mean, two things about Argentina that are sort of always true. Everybody will sort of laugh up their sleeve a little bit when they say, oh, well, we're going to lend money to Argentina again, are we? And then they go ahead and do it. And it's also always true that, as I said earlier, people just have a sort of affection for the place that maybe like a sort of blind lover just keeps them coming back. How do you see that? Tell us if you think
I think the
trade away first.
Yeah, I mean, I think there has been quite some volatility in how people are looking at credit over the past year. I mean, I think the Milei administration started with big hopes, and then they wobbled, I think, on FX policy for some time, and then but then they got very strong mandates and political capital from the congressional elections that even I think they didn't, expect. And what we're seeing since October is that there is certainly more of an effort to improve the FX system, decrease the vulnerabilities, repay debt. I mean, I think it was very close. It would have been if we got a congressional election result that was similar to the Buenos Aires provincial election, we were going to go back to, I guess, not so long ago, 2 years ago, of that, triple C's concerns, potentially another IMF program, potential, re-defaulting on already defaulted bonds, etc. But I think they did get a tailwind from that public support, which I think is the most important. As mentioned a few times in this panel, there is strong U.S. administration support for this administration as well. So in general, I think the momentum is positive for Argentina. I wouldn't be surprised that they have every banker in the world pitching them a deal to come to the market this quarter. And I think, as Gary said, I mean, if we get the reforms to bring them back to that B minus world, then which is still obviously a very fragile, part of that universe, but it will, we will be talking about a different Argentina. And in a way, the fact that despite a lot of high expectations that they could be in the market already, the fact that they haven't come perhaps is, something to think about as well. In that, I'm sure they looked at the Ecuador deal very, very closely. But it is it does serve them well in terms of investor confidence. The more they wait, and the more they just focus on the reform process.
Okay, good. Anybody have anything to add on Argentina? Obviously, other countries are unlikely to talk about their querido vecino.
Just one comment that I thought when you opened it up, and this is just something how we view the world. And when you're talking about Latin America, like it is so diverse, right? We're talking about Argentina, and then talking about some of the other issuers on this call. There are very different risks, right? So it can be challenging sometimes to lump it all into one basket, right? So.
Oh, completely, absolutely. I mean, Honduras to Brazil is a very long way in more than one way. I'm going to come back to the issues now and talk about, again, bread and butter stuff. One aspect of which is secondary market liquidity and how do you encourage it? And you can pick either that question, or you can pick the question on investor diversification and how do you achieve it. So I'll give you a choice for the next question, and I'm going to start in reverse alphabetical order with Uruguay. So Joaquin, choose your question. You answer both if you like, but secondary market liquidity, how do you drive it? And investor diversification, how do you drive that?
Well, starting with diversification, we main focus the topic in 2 points: investor base diversification and currency or market diversification. For example, to illustrate the investor base point, in local market, we do very deeper investor relation with banks, and they demand more of our local peso bonds. So despite the macroeconomic change, investor relation is very important. And regarding diversification of currency, as you know, last year we issued a two tranche bond in Swiss market for almost $400 million equivalent. And well, this serves both diversification objectives. And we see the main benefits as reduced concentration of holdings, increased potential demand, secondary market liquidity. And we also analyze our optimal debt portfolio. We try to sometimes issue, as you know, in shares or in the Swiss market to balance risk and cost, and always access funding windows opportunity.
And you've already told us a little bit about your investor relations, how you're sort of trying to boost that. So, Paula, is investor diversification is always a question in a bond market discussion. It's a bit like motherhood and apple pie, isn't it? I mean, do you target a particular sort of metric of how diversified your investor base is becoming? Do you try to point it in some direction or another, or are you just satisfied that the deal's covered, that's great, let's move on?
Well, I think the important thing, and it's really important to recall that 3 years ago, we moved from 35% of the issuance in hands of foreigners to 13% of issuance of foreigner in the local market. And as you may know, local market represents the 80% of our portfolio. So basically, where we do more the diversification is obviously when we do the external market issuance, and we try to always, normally United States have between 40 and 50% of the tenants of our issuance. But we have seen that Europe has more appetite for Mexican assets in the last transactions. Actually, we have been able to improve our transactions from 2 billion to 4 billion, almost 5 billion in the Euro market, which was not precedented. And by doing that, we are helping our portfolio to diversify in the external market and don't have a really only position in dollar market, because as you know, external shocks are really have a really good impact in our portfolio in the external market area. In the internal market, I think we're pretty solid. Diversification has been, I think that the most important thing of the diversification in the internal market has been the growth of mutual funds, pension funds. Like the internal market has grown a lot in asset under management, and we have seen a lot of development in finance. And I think the distribution in the local hands, it's really, we feel really comfortable. Obviously, most of the distribution is in the pension funds. Just for they manage in September 2025, they manage $438.4 billion in asset under management, which was a growth of almost from December 2020 to September 2025, 85% in terms of USD. So
would you ever consider, sorry to cut you off, but would you ever consider, or have you considered a particular offering for retail investors to inject?
We do have a program. It's called Zetas Directo. And we do annually. Last year, it was almost $32 billion of retail investors that Zetas Directo. It's a financial inclusion program where all of the retail sector can go to the platform and actually buy the instruments on the government on each weekly auctions in the price as they close the auction. And it has grown exponentially. And I think almost 25 billion, between 25 and 32 billion dollars a year. It was pretty good. And I think we are gonna try to make it grow faster because it's really important to us. And it's also another source of diversification. When the program started, it was really, really small. And right now it has impact in our balance, in the monthly balance. It is important to say that this retail is focused mainly on CETES that are coupon zero with really short term, like 28 days, 91 days, all that. So we still are in the process to have people to extend their investments to 5 years, 3 years, because right now it's really concentrated in the short term. But it's a really good funding strategy for the government and for the country itself.
Thank you, Daniel. What Paula's just mentioned about an increase in European investors buying dollar-denominated UMS paper, that is, of course, what we call de-dollarization. I mean, it sounds stupid for me to say that buying dollar-denominated bonds is de-dollarization, but of course, what de-dollarization means is not buying US-sourced US dollar-denominated paper. At least that's what I take it to mean. Have you seen in your $4 transactions last year greater presence of European accounts as well?
Yeah, we have been seeing that for the past years, especially because Brazil hasn't done a euro transaction in a little more than a decade. So if European investors want to expose themselves to Brazil credit, they need to do on the dollar. So we have been seeing them on the transactions, but not a real increase on the participations. Not a lot has changed in this past maybe 2 years, 1 to 2 years, in terms of increasing euro participations.
Okay, and is investor relations on page 1 of your priority list? With Uruguay, as we said earlier, Uruguay is quite a small country, and Joaquin said, at the moment there was a bit of a crisis. Let's make the best of it. Brazil is in a very different position, but how important is it to you?
We take that very seriously. We have a department, a specific department for that, and I think I need to just differentiate the strategy for external and local market. So in the external market, we have a target the talks to investors in conference on the bank conference, IMF and World Bank meetings. We try to go there and try to have an open dialogue with investors, pass the message what the government are doing. The other strategy is that on the transaction itself, to calibrate allocations so we can have the right proportions of the deal in each pocket. So we are trying to diversify and have the liquidity for the bond as was issued. And the other thing that I think would help not only diversify the investors for Brazil is the LM transaction that Brazil has done for a long time, and we are trying to re-implement the repurchase program that we had in the past. So that would increase liquidity, and investor would be more comfortable if they know that there is a way out for them if anything happens. So for the external market, that was the main strategy. On the local market, we have first, we try to develop the category, each kind of investor. So for the past maybe 2 decades, we moved from only banks buying the public debt to a more pension funds participation, asset management participation, foreign investors. So we are developing throughout the years those type of investors, so they would participate more on the Brazil debt. Now, for just an example, we have on the local market, 33% is financial institutions, 22% is pension funds, 20% mutual funds, and 10% non-resident. So that shows how diversified is the local market in Brazil. And on the liquidity side, we try to use our dealer program, so they need to provide liquidity on the secondary, so bonds are trading more. So that's one of the way to boost liquidity for the federal public debt.
Well, motivating PDs is something we always talk about in our European meetings. We haven't really got time to get into it now because we're down to the last couple of minutes. But Victor, we haven't heard from you on this topic. You happy with liquidity? You happy with investor relations? Just a quick response, if you could.
Well, I said diversification and liquidity are the same for us because many foreign investors said that the participation would be higher if liquidity would be better in Chile. Unfortunately, in Chile, we don't have, for example, market makers program. We are working on that. We're expecting during this year to have at least a proposal to implement in the market in 2027 to have the implementation and perhaps the more concrete effects in this regard. But along with that, the story, I think, is very straightforward. We are taking the chance of the momentum of the emerging market. We have seen more new investors interested, at least to know about Chile. And obviously, all the investor relations related with that, it's better. It's more information is better than no information at all. And along with that, to improve liquidity, it's a key, I think, because in Chile, if we compare with other Latin peers, the participation of foreign is still low in comparison.
Okay, well, it's tempting to ask the investors as a kind of final question, are you getting all the communications you want from these issuers? But we'll leave that for another time because I've got a better question for you than that. I did mention in the notes, of course, well, we did talk a little bit about gold and silver, but also Bitcoin. We haven't mentioned it up to now. So Bitcoin, gold, and silver have all behaved they've been behaving in a strange way for a long time, but they've behaved in an even stranger way just recently. I'm not asking you to comment on that specifically, but what I am going to ask each of you, you have less than a minute to do it, is to give us, this is the investors, or Greg can speak to if he wants to try out his asset management, his asset allocation skills. I want you each to give me a long, short pair, globally. You can have a Latin American leg to it. You can have Bitcoin on one side. You can have, I don't know, palm oil on the other. Every asset you could possibly think of. I want a long, short pair from each of you. And to make it fair, I'm going to ask. Oh no, I can't work out the alphabetical order. Gary, I think you're first in the alphabet. I'm going to ask you first. Oh, is he gone?
No, I'm here.
Oh, you're there. Sorry.
Yeah. What a difficult question.
Yeah, no, it's easy. It's what you do.
World is our oyster, right?
Mm.
Well, I think to make it relevant for the discussion, I think for the remainder of this year, obviously taking into account the moves we've already had in specific assets, I think from here, I would say we remain positive on Argentina and some of the sub-sovereign bonds or provincial bonds, such as Province of Buenos Aires, I think will look good from the long side and will be one of the top trades for the remainder of the year. And then on the short or the kind of more underweight side, I think for us, we still have a generally a positive view on risk into the rest of the year. So I think it has to be unfortunately, some of the investment grade names within the universe is kind of funders for the high yield space. So your kind of Perus of the world, where we see more beholden to the direction of US Treasuries and core rates, which I don't see overall meaningful total returns from those type of names against the high yield names. So more of a compression trade with long Argentina.
Okay, so keeping it regional then, so you're long Argentina, short Peru. Karen.
Well, Gary, started with the hard currency universe. So let me add something on local. So let's say BRL, with a favorable view on the election, and then on the short side, yeah, I mean it would it would have to be the US dollar.
Okay. Very good. And Jared.
I was thinking about for 2-3 minutes, I could say here. But I think unfortunately I have a similar view to Con. I was thinking to myself, I would take all these issuers in this room here, local currency bonds over their dollar bonds at this point in time. So.
Okay, so long local currency, short US.
For these guys, not for the whole. The
No.
GBI in itself is a different animal, but for the issuers on this panel, yeah.
Okay, right, good. Well, lady and gentlemen, thank you very much indeed for your attention, your answering questions, interrupting each other as you did a few times, which is what I always encourage you to try to do. Everybody out there in the world, I know you're all bursting to know about Venezuela. Maybe we should say that's a story that's yet to be written. But thank all of you for listening and watching, and most especially thanks to all of you panelists for taking the time to join us today. We'll be back with more soon. Oh, and I guess probably everybody on this call will be in Asunción next month. So we'll bump into each other there. Great stuff. Okay. Thank you, everybody.
Thank you.
Thank you.